This is a debrief of task 9 from the second sample assessment for personal tax. So task 9 is about capital gains tax, but reliefs and exemptions. So in part A, it asks us to identify whether the following statements about capital gains tax are true or false. So the first statement then, allowable losses in the year are deducted from chargeable gains before the annual exempt amount is deducted. So that's true. So imagine that we have a gain of 600 and then we have a loss of 598,000. So that would give us a gain of 2,000. Now our annual exempt amount amounts to 3,000, so you can see that we wouldn't be able to use all of the exemption because most of the gain has already been eliminated by those allowable losses. So yes, we deduct the losses from the gains first, and then if there's any gain left over, we can use the annual exempt amount, but potentially some of it may be wasted. Next, an additional tax rate taxpayer will pay capital gains tax at 45%. Well, let's have a look at the reference materials to help us with this. So we can see in section 15 of the reference materials that basic rate taxpayers pay 10% and higher rate taxpayers pay 20%. So there is no additional rate taxpayer, just basic and higher. So that means the answer is false. The additional rate taxpayer would pay capital gains tax at 20%, the same as higher rate taxpayers. The third statement is married couples and civil partners can only count one property as their main home at any one time. Well, yes, that's true. Yeah, we can only count one property as our main home. And then the fourth statement, allowable losses brought forward can only be offset against chargeable gains in the tax year immediately following the losses. Any remaining losses are lost. Well, no, that's false. We can carry those losses forward indefinitely until we use them with any future gains. Let's move on to the next part of the question. So Mr. Q sold a house for 440,000. He had bought the house 150 months ago and it was his main residence until he bought a flat 24 months before he sold the house. The flat became Mr. Q's main residence on the date of purchase. Mr. Q bought the house for 260,000. This is the only asset that Mr. Q sold during the 24-25 tax year. So we need to complete the following statement. So the total amount that Mr. Q will pay in capital gains tax on after allowances is. So it's not asking us to work out the capital gains tax. It says what is the amount that Mr. Q will pay capital gains tax on. So the word on there telling us that we need to work out what is the gain rather than what is the tax. So what we need to do then is work out what's going on with all of these months. Okay? So he bought his house 150 months ago and it was his main residence, and then he bought a flat, but that was 24 months before he sold the house, and this was then his main residence. So while the house was the main residence, then there'd be no capital gains tax to pay. You don't have to pay tax on the place where you live. So potentially we only have to pay tax on the 24 months when it is not the main residence. But having said that, the government does give an allowance of 9 months. So the 9 months immediately preceding the sale can be deemed to be your main residence. So that means that we only have to think about the 15 months while Mr. Q was not living in the house and ignoring the last 9 months. So that means then to work out our gain, we need to consider 15 out of the 150 months that we owned the house. Remember, for the first few years, we're living in the house, so there's no gain to calculate for that. So that's the proportion of the gain. So what is the total gain then? Well, we sold the house for 440,000, and then we bought the house for 260,000. So that's the overall gain, but then when we time apportion it, that gives us a gain of 18,000. Now, the question is asking us, how much will we pay capital gains tax on? Well, before we work out the tax, remember we'll be allowed to deduct the 3,000 annual exempt amount. So the total gain that we pay tax on is the remaining £15,000. Well, let's move on to part C of the question next. Dr. K had the following capital gains and losses in the last few years. So we can see that we've got 3 years there, and we've got 3 different annual exempt amounts, and then we have some gains and losses for each of the years. So we can see that in the first year our gains exceed the losses, and then in the second year our losses exceed the gains, and then in the third year our gains exceed the losses. So the question is asking us to complete the following statements. So the amount chargeable, if any, to capital gains tax for the 24-25 year is, and the amount of losses to be carried forward is. So in the first year then, so we've got our gains of 14,320, and then we have our losses of 8,450. And remember, what we need to do is we apply those losses to the current year first of all. So we'll have 14,320 minus 8,450 gives us a net gain of 5,870. And then we apply our annual exempt amount, but there's only 5,870 of gain left, so we don't use all of our annual exempt amount. So there's no capital gains tax to pay in that first year. And then in the second year, we've got our gain of 25,860, and then we can just wipe all of that out with our losses. So there is no gain in the second year. But what we can see though is that we have our losses of 37,220, and we've used some of those by removing the gain in the current year. So if we take the 37,220 and deduct 25,860, that tells us that we have losses carried forward of 11,360. And then in the final year, we have our gains of 18,740, and we have losses of 5,090. So we need to deduct that first of all. So if we take the 18,740 and deduct 5,090, that means we have still a net gain of 13,650. And then we can deduct our losses from previous years, but what we can do though is also use our annual exempt amount. Okay, so we can protect all of this. So that means that we only need to deduct 10,650 to bring us to a zero gain for the year. So that means the amount of gain chargeable, if any, is zero, because we have our brought forward losses to remove any remaining gain. So we've utilised 10,650 of our brought forward losses. So that means we still have £710 worth of losses that we can carry forward to the next year. And then finally, for part D of the question, Miss L made net capital gains of 20,140 during the 24-25 tax year. Her taxable income after personal allowances was 41,320. So you complete the following statement. the total capital gains tax payable is. So what we need to do then is, using our stacking method, and think about which band this is going to fall into. So we've got our basic rate band, remember that's 37,700, and then we have our higher rate band above that. So we know that she has taxable income after personal allowances, so she's got general income of 41,320. So that pushes us into the higher rate band. And then on top of that, we've got our capital gain of 20,140. Okay. Now remember, some of that 20,140 is going to be exempt, so we have our annual exempt amount of £3,000. So that means, therefore, that the amount of tax to pay, we've got our 20,140. We deduct the 3,000 annual exempt amount, so that gives us 17,140. And then we multiply by the 20% rate that's applicable for the higher rate taxpayers. And therefore our tax to pay is 3,428. Remember, 20% is the capital gains rate for higher rate taxpayers.